Hello and welcome back to another video. My name is Justin and today the stock market is having its worst day since June of 2020, right in the height of the lockdown and everything we were dealing with in 2020. So what exactly happened and how can we get prepared for the rest of the day? That's what we want to ask ourselves, because now as we look here at the market, not only do we have our worst day since 2020, we now have our lowest daily closing price going back to 2021, almost, right, we're looking at over a year ago. We've not had a daily close on the S&P 500 going all the way back here to March of 2021. So we're starting to see some pretty devastating price action and hard to ignore. What I want to look at next is going to be the heat map. So there was nowhere to hide. And if you were feeling bad today, again, join the club. We got an exact puke of everything that happened yesterday, and it is red everywhere. We're going to talk about Target in a moment. Part of the reason why we're seeing a huge overhang today. And looking here by market cap, we can note that every sector is red. I believe there's only about 8 stocks in the S&P 500 that are green. Everything else is red, right? S&P and QQQ are red, right? Gold is red, oil's red, NASDAQ's red, Bitcoin's red, all the trillion-dollar companies are red. Options are pretty interesting right here. We can look and see the put-call ratio and the put calls, but overall, every other ETF is also red. So what happened? WTF? And I think a really interesting way for us to look at the S&P 500 is not by market cap, but by number of employees. So when we look here, it's pretty obvious to tell that retail is the sector of the S&P which has the highest employee count. So what does that mean? It means that labor costs are really a big issue. And what we heard from Walmart yesterday when I said, look, it's a bad omen. I got to talk more about it tomorrow, but here we are. Target also had a devastating earnings report. So as we look over here to Target and the carnage that came in today, I have a little bit of a silver lining. And the silver lining here is that we can look at the daily candle and see what happened. We actually have a doji, which means indecision. So maybe the size of the gap down that we got today was enough to flush it out. And we have to remember that the opening price is as important as the closing price. As we look here at Walmart, into the close yesterday, again, this was a bad omen, but it was not confirmation until we heard from Target. So gap and flush, right? It opens and it flushes lower. We had that exact same thing happen today. Gap and flush, closing where? At the low of the day. And this is important because as we look here to the percent decline now, Walmart's only down by about 18%. Target got it all out of the way in a single day, and it's pretty important that we keep that in mind. So Walmart might still have more downside, whereas Target, again, if it's going to bounce, there is potential it could. I'm not calling for a bounce. I'm not saying it's going to bounce. I'm just saying that generally speaking, if we're able to hold roughly the opening price on a huge gap down, it means that maybe we're not going to do what Netflix did. And remembering that Netflix was one of the first companies to report a soft report, right? Here we go. There's that rip before the ultimate fade. And then there's the gap down on earnings where we ultimately flush. So I don't know what's in store. One last thing to talk about here for Target and Walmart before we move forward is just that we have to ask ourselves, what are these companies worth? Because when we look here at the price to earnings for Target, it's now at 15. That seems pretty reasonable. Well, that's not where it was yesterday. The issue with Walmart, which is actually a bigger part of the S&P 500, is that it's still valued at 26, 27 PE. That's including its 17% decline. And now what we have to ask ourselves is Walmart a growth stock or is it a value stock? Because if it's a growth stock, then it should be valued here. However, what are some of these huge trillion-dollar companies valued at? Are they valued above or below 27 PE? Let's look at Google, the one that had the biggest negative reaction to earnings. Oh, Google's actually cheaper than Walmart at 21 PE. Yes, it is cheaper. What about Facebook? Facebook's currently at 15 PE, same thing as Target. Oh, wow. Yep, it compressed the PE here. What about Apple? Apple's trading at 24. It's roughly 10% cheaper than Walmart. Wow, really? Yep. Looking at Microsoft. Microsoft's at 27. So would you rather own Microsoft or Walmart? That's what we have to ask ourselves. And the difference between Walmart and Target and these other companies is that these companies like Amazon, the trillion-dollar companies, they all just gush cash. They're gushing it. They got cash on their balance sheets. They generate cash like you wouldn't believe. And I think that what's happening is people are scared about inflation. There could be any number of reasons why we blame the decline today. I think that people are forecasting the future. So again, we know that the market is a future discount mechanism. So the market is discounting to the future, and we're right back into extreme fear here. So we were roughly at this area a week ago, and now we are, again, from 15 yesterday back down here to 9. This is really bad. Part of the reason why I think that Home Depot and Walmart, again, just looking here at the chart, this is already what they were talking about yesterday. Home Depot stock relative to Walmart shares mirrors previous downturns. What this means is that back in 2000, 2008, and 2020, when the relative price for Home Depot to Walmart started to have a downturn, that predicted the recession. And I think that if people were already aware of this yesterday, what we heard from Target today just did not help. It was another nail in the coffin. The next thing I want to look at here is just that we also had the S&P now back below 400, QQQ below 300, BTC below 30K, ETH below 30K. So just like we're not looking for a single day to call a trend change, we're not looking for this to hold for one day to say that we're now out of the woods. We had one day above and we're right back down below. So we're probably going to have to see a couple of days for us above all of these areas for us to actually say that we're going to be putting in a bounce. There we go. This video might still be a little bit longer because there's a few more things I want to go through. So I do want to talk about Warren Buffett, but before I get to there, I just want to talk about this right here. So when money is expensive, everything else gets cheap, right? That is a very big difference from where we are today. Today, we're in the, again, leading up to today, right? For the last 2 years, we've been partying on free money. What does free money mean? It's cheap. So if money's cheap, everything else gets expensive. I'm talking about share prices, right? Food, commodities. Now that we're in this environment where if money is expensive, everything should get cheap. We're not talking about food. We're talking about valuations, right? Stock, housing, all that stuff. So we have to remind ourselves here that the S&P is the yellow line here, and the white line is the Fed's balance sheet. We've not even started reducing the balance sheet yet, which is going to start on June 1st. And we're already getting those huge declines. We're now, again, at the worst level since 2020, worst one-day drop. And we're now at a closing basis we have not seen in over 12 months. So the big question is, do we want to trade or do we want to invest? Because if you were trying to be a stock picker right now, even buying something like we would have thought would have been safe, right, like Walmart or Target, not so safe. You are the fish swimming upstream. And what happens to fish who are swimming upstream? They get to the top and they die. Do they die by getting eaten by the bear? Do they die from exhaustion? Or do they die from their own means? It doesn't really matter. They get to the top and they're dead. So we've talked about this before, and trying to be the stock picker right now is just not working. So if it's not working right now, what we want to try to do is maybe learn a little bit from Warren Buffett. And that's what we have in the title of the video today. Right? Don't watch. Don't watch what? Well, Warren Buffett, Jack Bogle, and financial planners agree. When stocks are down, don't watch the market closely. He's not saying don't watch, but watching the tick by tick and for the market to fade right back down to the dungeon and then into the basement and even lower, it's not fun. So Warren Buffett's doing something different here. And we can also note that as of Monday's close, we heard about some regulatory filings, and he went to work. He bought $51 billion worth of stock in Q1. He didn't sell them back either. And what's important here is that Warren Buffett is buying for the expectation of not holding on for a couple minutes, couple hours, couple days, couple weeks. He's looking for years, if not decades. And he is a value investor. So what's so important about this? Well, what's important is the quote that we see here from Warren. This is from a financial planner. If you miss the recovery, there's a very good chance you're going to make it harder to hit your financial goals. And there's something called the worst day predictor. Generally speaking, we don't know exactly which day it's going to be, but when we hear about the worst day since, it's usually followed by the biggest day since. So the question is, have we done enough damage? Do we have to have one more day? And frankly, I don't know. The last thing I just want to point out here is I'm going to delete everything here and just show one more thing, because when we look back to the period here where we had Jerome Powell speak last time versus what's happening now, it's less important to, from my point of view, to understand the exact reason why we're down. It just matters that we're down. And we can note here when Jerome Powell spoke, we had that unbelievable squeeze. It wasn't confirmed with volume. Same thing happening here. We fully reversed it. And we are now where? We are below the closing price from the previous day. Here we closed just below. That's where we rejected. So what'll be so important for me going forward is getting back above yesterday's low. Yesterday's low, 402.5. Until we get back above there, I think we're repeating the same pattern here where if we're going to go for a dive lower, it could happen. And the reason why I say that is because when we look here at the S&P on the hourly chart, we finally got our volume breakout. We've not had strong volume at the open or the close for quite some time, and this is very unusual. In the summer, we usually see lighter volume, but I also just think that there's a lack of liquidity. We're literally anticipating tightening. So if we're anticipating tightening, that's what the market's doing. There's no liquidity, but it's still orderly. Why? We're staying range bound. Low volume only up until the close. And this is what I mean by some of the biggest worst days are usually followed by some of the biggest green days. The recipe is here. We have to see the continuation. But on the flip side, we now have to ask ourselves too, well, where could we go? We have to get above 402 to start. That's 10 points. And then 10 more points before we got to get above the 412 area. So what really matters for me is where we close out on Friday. Meaning, are we going to be above or below? We've already had, so we have 6 back-to-back red weeks as of right now. Perfect bear rejection. And I want to make the video a little bit longer. And the reason why I want to do that is because like yesterday when we were talking about, right, let me just take a quick little screenshot here. So we were talking about how it's now professional time. So here we have Monday, here we have Friday, here we got Wednesday in the middle. Today we got VIX expiry, right? We got VIX right here. Now we got VIX. Over here we got SPY. We got SPY expiring. We got QQQ expiring. Oh yeah, I can't even spell. There we go. SPY. Q. Oh geez, man, my spelling is terrible here. SPY. Q. Okay. Yes, I want a Q. So we got the Qs. And then we also got individual single stocks expiring. So what does this mean? It's professional time. It's like we're going into the final 2 minutes of a football game, right? Yep, it's professional time starting on Wednesday, going to Friday. So if the market price action's been hard for you to trade, it's probably going to get harder into Friday. So just be mindful of that. There's a whole bunch of money expiring. I still believe they're going to rip it higher into Friday. Because of the ability to burn the puts. So that's why I'm looking at this volume breakout here and thinking that if we're going to reverse, hey, I think people are pretty ready to fold. I think they are. I don't know if the sell-off is done yet, and we have to be mindful of that. The reason why I want to make the video a little bit longer is because I want to spend a few minutes here going through some of the most important ETFs and stocks that I care about. And the reason why I want to do that is because when we look here at a weekly chart, even though we're down by 2.5%, what do we have technically? A higher high and a higher low. So until we lose yesterday's low, we're actually putting in a constructive move. This is the weekly chart. The week's not over. We still have time left. So for SPY, we actually have to enter bear market territory and print a weekly lower low below 385 for us to actually confirm this bear move. Otherwise, this is actually consolidation. And when we look at SPY versus QQQ, SPY's at 391. QQQ's at 291. So this is still orderly. We haven't seen the unorderly part yet. I think that's going to happen, but it does not mean we're not going to get relief first. So now, second thing to look at here, the S&P is more bullish than QQQ. Why? Well, QQQ does not have a higher high. It has a full inside bar. So what is that? That's consolidation. It's consolidation 101. Looking at the next major chart here, I want to look at Bitcoin. So what does Bitcoin have? Tight inside bar. Yep. It's an inside bar. We got a lower high and we got a higher low with a huge flush of volume. If this is the bottom, consolidation's fine. It's okay. Now the next one I want to look at here is going to be Apple. Apple, yep, it's closer to the low, but it's still an inside bar. We got a lower high and we got a higher low. And now looking at Apple, we are now starting to break bear, but not quite there yet. We can note that the next support's going to be at the previous top here at roughly 137.5. But Apple is still technically within a consolidation pattern. It's still got an inside bar. Now, as we look here at Tesla, again, even with a huge decline today for Tesla, almost 7%, it still has an inside bar. It's still above last week's low. So we note that all of the major risk assets, including all the ones that I've listed here, again, S&P is currently, right, we'll take this again one more time here and just summarize it. So this right now is currently below, meaning SPY is below 400, QQQ is below 400, BTC below 30K, ETH below 2K. But we're holding the weekly lows, and that is why this is particularly confusing. It's very hard for us to know what's going to happen. And if we want to dip our toes into any of these individual stocks, what we want to try to do is to make sure that if we're trying to be the trader who is going to swim upstream like the fish, we have to be prepared to die, which means you have to be prepared to be wrong. The last thing I'll just mention here regarding Warren Buffett is just that when he's looking at names like a Paramount or like a Citigroup, I know what he's seeing. I've been trading Paramount since the beginning of the year. He's looking at the PE ratio of 5. It is below intrinsic value. It's trading at a PE of 5. That is dramatically lower than any of the other ones we just looked at. It also has a dividend of 3%. We now look at Citigroup, and Citigroup here is trading at a 6 PE with a 4% dividend yield. That is juicy. So what's important about Warren Buffett putting his money to work is just that he is prepared to hold on. And the thought I want to leave you with is that Warren Buffett is known as a value investor. He put $51 billion to work this last quarter. So he believes that right now the market is on discount. He also has cash on the side, which means if it gets even deeper, he is ready. So, as we've talked about before, what you want to try to think about is whether or not you want to be like Warren Buffett or be an investor, or if you want to be a trader. A trader wants to capitalize on short-term moves, and an investor wants to capitalize on longer-term moves. Right now, it is very tough to call direction. However, the dominant trend is bearish, and until proven otherwise, the bears are in control. If you want to know my deeper thoughts and how I prepared my notes for this week, or if you want to see again, how we got to here, I encourage you to watch the video that'll come up here at the end of the video. And I thank you very much for watching, and I look forward to seeing you tomorrow. Thank you.